Let's jump right into this. Welcome to this explainer. Today we're unpacking one of the most wild, volatile, and frankly fascinating financial ecosystems on the planet, cryptocurrency. But we're not going to look at it through the usual lens of blockchain code or cryptography. Scratch that. Instead, we're looking at it through a much more revealing lens, our own minds. We're going to see how our brains literally construct the value of these digital assets.
To set the stage, Nobel laureate Robert Shiller really hit the nail on the head. He said, popular stories serve as the primary drivers of economic choices instead of analytical frameworks. And what's absolutely crazy is how perfectly this defines the crypto space. We are looking at a fundamentally behavior-driven asset class. I mean, in traditional finance, you look at a company's cash flow, right? But in crypto, the narrative actually dictates the value. The story literally is the fundamental.
So, that brings us to the central mystery of this whole explainer. In a market with basically zero traditional fundamentals, what is actually set in the price? Think about it. When you strip away the quarterly earnings, the dividends, the physical balance sheets, what makes a digital token worth a single penny or, 60,000 bucks? Keep that question right in the back of your mind, because the answer lies entirely in how we're wired.
All right, here's our roadmap for today. We're going to start with psychology over fundamentals, move into the market's behavioral amplifiers, look at historic bubbles and crashes, dive into Spark as a modern case study, and finally, wrap things up with future realities and risks.
Okay, part 1, psychology over fundamentals, establishing the baseline.
To really grasp this market, we have to talk about cognitive biases. Because, believe it or not, this isn't just random chaos. It's highly predictable human error playing out on a massive digital scale. Let's start with prospect theory. First developed by Kahneman and Tversky, it basically proves we fear losses way more intensely than we value equivalent gains. In crypto, this turns into the disposition effect. Basically, investors will stubbornly cling to losing assets because selling makes the loss real, while simultaneously chasing wild lottery-style token surges just to avoid missing out. And this gets heavily amplified by herd behavior. That's our natural tendency to base financial choices on what the group is doing. In the crypto world, solid independent research is so often totally replaced by social contagion. We're talking about digital echo chambers on platforms like X and Reddit that create this environment where group sentiment tells you what to do, not hard data. If everyone is sprinting in one direction, our deepest instinct is to just run right along with them.
Which of course ties directly into FOMO, the fear of missing out. We all know that gut-wrenching anxiety that a life-changing financial opportunity is happening right now and we aren't in on it. But here is where it gets incredibly dangerous. It's when FOMO teams up with something called mental accounting. This is when traders start viewing their recent crypto profits as just house money. They start taking these massive, super impulsive risks because, well, their brains don't even view those funds as their actual hard-earned cash anymore.
Moving on to Section 2, the market's behavioral amplifiers, a structural divide.
Now, these psychological biases, they exist in all of us, but the actual architecture of crypto platforms weaponizes them. Think about traditional markets. They have built-in cognitive boundaries. They close for the weekend, they have set hours, they're heavily regulated. That gives your emotions time to settle down. But crypto markets, they never sleep, 24/7, 365 days a year. Add in gamified interfaces, leaderboards, flashy push notifications, dopamine-triggering graphics. This uninterrupted access removes any sort of mental breather, pushing folks toward incredibly impulsive and addictive trading patterns.
Let's look at Section 3, historic bubbles and crashes, the graveyard of hubris. Let's look at some history, specifically the dramatic 2017 surge where Bitcoin skyrocketed to almost $20,000. Now, what actually drove this? It definitely wasn't some massive tech upgrade to the network. It was driven by the availability heuristic. Our media was completely flooded with these flashy crypto millionaire stories, and those vivid, highly visible narratives became the only proof new investors needed. Combine that with anchoring bias, where everyone just fixated on the next arbitrary massive price target, and the crowd fueled a massive bubble built almost entirely on socially transmitted hype.
Then, fast forward to May 2022, and the total collapse of Terra Luna. This was an absolute disaster that wiped out over $60 billion in just days. Honestly, Terra is a masterclass in confirmation bias and social proof. The protocol was offering these completely unsustainable 20% yields, and even though analysts were practically screaming about the fundamental red flags, the community willfully ignored them. They were completely blinded by present bias, chasing those immediate massive yields. and a cult of personality around the founder. The story simply overpowered basic risk control.
And maybe the most shocking of all is the November 2022 implosion of the FTX exchange. I mean, just look at the absolute cliff drop in its value. FTX was supposed to be the gold standard of institutional safety, but this failure was built entirely on authority bias. The founder, Sam Bankman-Fried, used all this altruistic rhetoric to create a true governance illusion. The narrative was so blindingly strong that everyday retail traders and massive institutional investors alike completely failed to demand basic fundamental things, like an independent board of directors or actual financial audits.
Which brings us to Section 4, Spark, a modern case study. Taking this from theory to practice.
So, let's talk about SPK, or Spark. What is it? Basically, it's a protocol designed to merge decentralized finance with real-world assets. Specifically, it lets users earn yields through traditional financial instruments, like U.S. Treasuries. And they're doing this notably through a partnership with BlackRock's Butyl Fund. That is a highly compelling, very modern narrative, and guess what? That narrative is absolutely working. The protocol has already amassed a staggering $8 billion in total value locked.
But what's really fascinating here is the stark contrast in valuation. If you compare SPK's market cap against absolute giants like Ethereum, Solana, or even Dogecoin, which are valued in the tens to hundreds of billions, SPK sits at a comparatively tiny $133 million market cap. From a purely psychological standpoint, this massive gap between an $8 billion total value locked and a $133 million market cap creates this incredibly powerful hidden gem narrative. It triggers that exact FOMO we talked about earlier, as investors desperately hunt for an asset they think is massively undervalued.
But hold on, because the tokenomics tell a very different structural story. Out of a 10 billion token supply, a massive 65% of it is fully allocated to sky farming rewards over a 10-year period. So what does that actually mean for the price? It means there is continuous, long-tail inflationary pressure on the coin. Every single day, more and more supply is being dumped into the market. If the demand, which is driven by narrative and adoption, doesn't outpace that new supply, the price is going to face some severe downward pressure.
We are literally watching a real-time tug-of-war right now. On the bullish side, SPK has secured major exchange listings on places like Binance and Upbit, which opens up massive retail access. It even saw a $1.3 billion inflow of capital rotating out of the AVE protocol after a recent exploit there. But on the bearish side, we are seeing huge whale manipulations. For example, Justin Sun recently moved over $93 million out of Spark. Combine that with the technical realities of token unlocks and supply pressure, and you have a perfect, real-time example of pure sentiment battling hard structure.
Finally, let's wrap up with Section 5, Future Realities and Risks, the Adaptive Market.
So, how do investors actually survive in a space that is so completely defined by emotional extremes and structural volatility? Well, the answer might actually lie in the adaptive markets hypothesis. Formulated by Andrew Lo, this theory suggests that market participants continuously adapt their strategies to survive in shifting, highly uncertain environments. Looking at it from this angle, maybe this extreme reliance on social echo chambers, the fast emotional trading, the relentless narrative chasing, maybe it isn't actually a failure of logic. Instead, it might just be an adaptive survival response to a market that's completely saturated with complex, fast-changing info and absolutely zero traditional fundamentals.
And that leaves us with a final provocative thought for you to take away from this explainer today. As we watch these protocols desperately try to tie themselves to real-world assets like U.S. Treasuries, we really have to ask ourselves, are we, as investors, finally adapting to value true fundamentals in the crypto space, or are our brains simply finding a newer, much more sophisticated story to tell ourselves, blindly buying into the next great narrative? I'll leave that for you to decide. Thanks so much for joining me, and as always, keep questioning the narrative.